following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. If you haven't done so already, I encourage you to go out and check out the latest edition to our programming lineup, The Wide World of Options, brought to you by our friends over at the Options Industry Council. It is, as the name implies, a very broad look at the world of options, a little bit of strategy, a little bit of analysis, a little bit of what's trading, education, interviews, all that fun stuff, even some book reviews and everything else. They really do a lot of crazy stuff over there on that show. I encourage you to check it out. You can find it on theoptionsinsider.com or over there on iTunes, Stitcher, Aha Mobile, wherever your podcast provider of choice may be. Check it out, The Wide World of Options. Pretty interesting stuff. Of course, speaking of interesting stuff, we have a lot of that in store for you today on the old Option Block program. Joining me, as usual, is our cast of characters for the old All-Star panel, starting off in the center this time, the man right down the street from me. You know him, you love him as the Viceroy. He is none other than Alex Jacobson from Options Express. Mr. Viceroy, welcome back to the program, sir.
Thanks, Mark, and welcome home, and a wild day today.
Yeah, to say the least. Yeah, I get back from Florida, and we got a little bit of action to greet me, so that's kind of nice. Something to talk about today. From the pure media production side, it is very good stuff. We have stuff to talk about.
Yeah, amazing. And think about it. Tomorrow morning is expiration. The Spider goes ex-dividend tomorrow. I mean, none of this is kind of relevant because the show won't post, but it's quadruple witch, and you moved 40 points in the S&P. You moved almost 5 handles in VIX. A keen reminder why most brokerage houses won't let you trade VIX with minimum margin. But yeah, today was kind of textbook horrible.
I came back from vacation this week, so I had a bit of a shortened week. So I spent half the day in my mind thinking today was Friday. So I was thinking it was expiration day already. Then I was like, wait a minute, it's only Thursday. So that put some of my trading in a little bit more perspective as to why isn't this decaying the way it should be. But interesting stuff nonetheless. Yeah, a lot to talk about. But before we get into that, we have to introduce the rest of my cohorts on today's show, starting off dramatically far to my left from a political spectrum, if nothing else. We have, of course, Uncle Mike Tusaw from RCM Asset Management. You degenerate lefty, you. Welcome back to the show, sir.
Oh, come on now. I've been accused of, I'm a lot of things, but I'm definitely not a left-winger. I will say that for sure. But, yeah, a lot to talk about today. That is for sure. A lot of things going on, and hopefully my kidneys can survive what they went through today.
Yes, we were very concerned about the BBI as today, and for those of you newer listeners, it is, of course, our inverse indicator of market activity? Low or high BBI today, Uncle Mike? I have a guess. I think where it fell, but let us all know for sure.
Well, thank God for Wi-Fi, and I could take the phone with me. Let's just say that.
Yes. A lovely picture for all of our listeners. Let us quickly move away from that and welcome our last co-host for the program. He is none other than the Rock Lobster from the land known as OptionPit.com. He is Mr. Andrew Giovinazzi. Andrew, welcome back to the program, sir.
Well, I can only say it is a pleasure to be back, and it's glad to have you in the hot seat in Chicago, mostly because now we finally get the music again between parts of the show.
You get the fun live production elements when you're doing the show, which always makes it a little bit more fun, a little bit more snazzy. I know I like to dance a little bit when that intro pops up. It just gets the blood pumping.
It does. It makes it happier for me. Of course, our listeners never hear that because all they hear is the expertly crafted final product.
Exactly.
By Kyle, but in the short run, we get to hear the music, which jazzes us up a little bit.
Gets us all pumped to dive right into the trading block.
The trading block.
All right, this is the trading block, and as the name implies, we dive into what was trading, what was moving ye old market today. And I get off the old plane from Florida, and I am greeted by a sea of red across the board, with pretty much all of the major indices down over 2% today. The S&P leading the charge, down nearly 41 handles, or 2.5% to 1588. The Dow and NASDAQ following suit, each down, down about 2.3% respectively on the day, and the VIX cash roaring up to the upside, up nearly 4 handles to 20.48 on the day. So it was just a blood red day pretty much everywhere you looked in the marketplace, except for the VIX cash, of course. All of this being driven by our friends over there at the Fed. If you listened to our show earlier this week, we all pretty much had eyes out for the Fed. Everyone was watching for the Fed, kind of keeping your powder dry ahead of that big announcement, and now it looks like that's starting to pay dividends in the old marketplace. Fed chairman came out yesterday and said they're going to start cutting their bond purchases, and there were some stories today that economists are estimating that they're going to cut those bond purchases by about $20 billion a month. That's billion with a B. So starting at the September Fed meeting. So that's a substantial amount of money coming back out of the economy, coming back out of that easing program. And so that was enough to send the market into a tailspin today and caused a lot of this pronounced sell-off. Of course, you could argue, if you've been watching this extended rally for quite a while, that we've been due for some time for a bit of a correction. This was all of that just bottled up into 1 or 2 days, and of course, we saw a little bit of this yesterday, certainly not to this extent, but the Fed really taking the legs out, taking the wind out from the marketplace. I think we'll start with our farthest contributor from the land known as Maine, Mr. Andrew. In the entire maelstrom of activity today, what in particular really caught your eye? Perhaps we'll start in your wheelhouse, if you will, in the land with the product known as the VIX. What really caught your eye in today's VIX activity? Of course, yet another historic milestone that all of our friends in the broad media not afraid to point out. VIX breaking the 20 handle for the first time since December, so pretty much a 6-month span below the 20 handle. Now we're back up in the 20-plus range. What in that movement really caught your eye today?
Yeah, it's funny, Mark. We've avoided being short volatility for the last, I think the last 9 or 10 days. So, it was good for us. What caught my eye is actually that it could have been, I think, still much worse. VIX is up. I mean, we say this all the time. VIX is still a measure of movement. And, a 2% move is, 32 VIX. And we're actually a little more than that. So VIX should be 20. All right. Should be 25. Okay. Maybe 26, at least just on the realized vol move alone today. So the fact that it struggled to get above 20 too, and that'll be a blog for me today anyways, writing it up just before the show started, but it should be worse. So I think there is basically the market has not figured out how much of this Bernanke premium to take out. I thought around 1600, maybe 1580, something like that, where they kind of whatever that was basically everybody just getting in when they had missed the other 3,000 point rally in the Dow. So that money seems to be gone, and we're looking at a market now the economy has to go to about worrying about, okay, like good old-fashioned growth stuff. So, the market never got crazy, I think, overvalued. It just happened a little fast based on that, that constant Bernanke put. Now that put is kind of going to go away, and everybody has to swim on their own. So I didn't think it would be, catastrophic like 1,400 on the S&P 500, but it's kind of getting to a level where I don't know if we're going to see a whole lot more, maybe 1,550 or something like that. And then people start to take a look around now. The coast is clear. The sun still comes out and they go, is this company still worth buying if we have a moderately growing economy? So, but from a vol point of view, the volatility moved up very measured. It did not explode, which generally means to me there's not a tremendous amount of panic. I mean, vol should go up because the market's going down. That's how the VIX works. But it didn't panic up today. Now, tomorrow could be another day. If we're down another 2-3%, people will probably get a little bit touchy. But at least for today, I think the vol move was measured. I wouldn't sell the vol products, but we started like dipping our toes in with like iron condors and stuff like that, and keeping sort of a wide, let's just call it a wide swath around what could be a market that the lows could very well be like 16% vol. I thought earlier in the week 15% would be the low, and we never even got close to there. And I don't think anything's changed. If anything, we probably start to move, 0.5 to 0.75% a day, a little more now, because any little piece of snippety news could be the Fed beats a more hasty retreat, or let's say, as in the Bernanke speak, takes his foot off the gas pedal a little quicker, and that could signal I think more movement, more realized vol in general. So again, it was definitely the market sold off hard, but from a vol point of view, I think it could have been much worse.
Yeah, from a vol perspective, it has been an interesting couple of days, to say the least. Of course, our email was inundated yesterday, as it is anytime the VIX seems to underperform. Yesterday, of course, we had another pronounced sell-off, certainly not as extreme as it was today, but of course we had all of that juice, all of that premium that had been built into the balloon prior to the Fed announcement. So that, of course, was coming out at the same time that the market was selling off. So the VIX cash ended up net down on the day, which, of course, sent a lot of people who are diehard VIX traders or just interested in VIX flooding to our email and to our website saying, why is this happening? Why is the VIX moving in conjunction with the underlying? Of course, that brought out all the VIX is garbage comments and everything else like that. But that was kind of just expected given a day like yesterday where all of this juice had been built up. It has to come out eventually. It's like an earnings cycle, like any other big announcement time. And then a day like today, you're right, it did kind of struggle to get up above the 20 handle. So that shows that perhaps there still was a little bit of reticence out there to really start piling in and start bidding up this vol, even in the face of very, very aggressive, prolonged sell-off. And I agree. I think tomorrow is the true litmus test. If we continue in this range, of course, 2.5% obviously is going to set everyone off into a tizzy again tomorrow. But even perhaps half of this as a sell-off again tomorrow, I think will show people that there is still some pronounced weakness. Because unlike other days we've seen of recently, how many times have Alex and I complained about how we have to tear up our notes halfway through the day? Today, that wasn't really the case. Today, we saw a few times where we started testing a little bit and looks like it might bounce off the lows. And it did bounce off the lows for a little bit, but then it just got slapped right back down. And we closed pretty much on the lows as well. So that, I think, for a lot of people is going to be an interesting indicator for where we open up tomorrow. And if this pressure is out, if the real safety valve has been released and people have finally got some of this off their chest, or if they have a lot more in store. Going into the weekend, perhaps we'll roll on over to you, Uncle Mike. What in today's swirling vortex of red really caught your eye and kept that BBI nice and low?
Well, there's one strategy that I did today, but I'm going to save that for the strategy section later, or for the strategy block a little bit later today. But just kind of going through it, going into the day, I was looking at, I felt I was overhedged in silver and underhedged in gold. So obviously they both went down, but it worked out okay. And this is kind of one of those days where magically clients don't complain about all the protective strategies with which we do. A couple of things that I thought were interesting is that we had a lot of movement to the downside in pre-market. So if you were to look at the S&P, the E-mini in pre-market, we were down probably about 15 points. And a lot of times with that, obviously it's something that kind of catches your eye, but we just kept going. There was really no point with which the bulls had any control whatsoever, except for maybe the first 3 minutes of the market. I think we were up a little bit, something like that. But nonetheless, this is just a straight up sell-off throughout the entire day. Just kind of looking through my list of things with which I like to look at. I've been wanting to start selling some put spreads in Apple for a while, but it needs to be kind enough to not go down a lot for me at least one day, and I'll be glad to start doing that strategy again. Once again, with gold and silver, I felt I was overhedged in silver and underhedged in gold, but it worked out for the best, I guess, on the downside hedge. So with that, I think that kind of sums up what I was looking at. And then one other thing with IEF, I talked a little bit last week about the bond strategy with which I was initiating. Just to kind of give you guys an idea of an update on how that worked, going into the strategy, long IEF at 104.60. Sold a 105 covered call for this week, or June, for 35 cents. So with that, let's assume for a minute that that call expires worthless tomorrow. Obviously, anything can happen, but let's just assume that that's the case. Cost basis on the trade, we got 35 cents for the call. 104.25 is what we're coming out to on that. We got approximately 50 cents for the TLT bear call credit spread in doing that. So on this, in my estimation of bonds, well, I'm trying to set up in the ratio of this, and let's just say that we did one call spread for every 100 shares of IEF that we have, which for the most part, that's what we did throughout the client portfolios. Basis on this trade is just under 104, and IEF's at 103.12 right now. So the point that I want to make with that is that, yes, we had a major sell-off, even in the bonds as well, but when you manage the risk and you're able to sell more premium and manage your deltas like we did, this is something that's manageable. And I still feel that I don't think bonds are I don't see the 10-year going to 5% overnight or anything like that. But I feel that if we have a slow ride down, or if we just even stay somewhat still in the bond area, this is something that I think is very viable. And with that in mind, I think that if you want to have bond exposure in your overall long-term portfolio, there's things with which you can do to kind of weather storms like these last 2 days.
You're a brave man slinging options out here in this IEF. This thing does a whopping 600 contracts a day, so you were a good chunk of the liquidity today, Uncle Mike.
Well, this is one where it's you sell the covered call, and if you get assigned, you get assigned. I'm not trying to adjust it. I'm not trying to do anything on it. This is a very passive strategy. The way with which I'm adjusting and doing stuff, as a wise man would once say, is that I'm managing that with the TLT options.
So this is very much a Ron Popeil set it and forget it type of trade.
On the IEF section, yes, but it's definitely not set it and forget it because of the fact that we're using TLT to do stuff. The TLT options, I should say.
Always have to be doing stuff, as our friend the Lobster likes to remind us in his forthcoming subtitle.
You have some marginable problems there with that.
Yeah, that's true. And so just to reiterate then, so you're still eyeing some downside put spreads here in Apple. You're just keeping your powder dry until things settle out a little bit before you start blasting away on the dark side of that juice.
Pretty much, yes.
And you also, I know you were keeping a keen eye on Google breaking that 800 level. Of course, it went way past that, over to 900. Did you ever dive into those waters?
Have not. Been staying away from that.
You're killing me with these short answers here. Okay.
I know. One thing about Apple actually was one of the better performers relative to the market of a lot of the stocks today, because we actually in our little strategy letter for Option Pit, when we every day we go over trades with with clients, and we're actually long Apple straddles today. Mark actually is going to do that and follow the trade for the CBOE, but something happened with the tape or whatever. But that was from Monday. So of course today the thing is blowing up like a total balloon. But I'm sitting here looking at Apple like, can it at least participate with the rest of the market? I mean, it finally did toward the last 2 hours of the day, but it's holding up, I think, remarkably well. Not that it has done anything at all this year relative to everything else. I mean, basically the whole market rally past Apple buy. I think it's actually down for the year. So, but I think as a stock that seems to be holding up well when everything is going bad, I have to agree with Mike on this. Apple is starting to look better from that point of view.
Yeah, that's right. It's an interesting perspective, actually, that if you were one of these buy and hold guys in Apple at the beginning of the year, you pretty much you missed. Not only did you miss the rally on the broad index, but you sold off quite a bit. It opened at the beginning of the year at 553. So we're well off 100 plus handles from that. So you're down substantially if you've been a buy and hold Apple guy this year versus the broad market instead. So yeah, Apple not exactly leading the pack the way it once was. I know they had their WWDC, their developers conference last week, and they made a big push to saying, our innovation isn't dead and we have all these great things coming out. But they obviously are feeling that heat now because they even have to come out and say it on the stage. We can still innovate.
Their innovation's dead.
Yeah.
And they're a utility. I mean, it's a great company. It's a great utility. It's a giant utility. It makes $50 a year, and they're probably going to do that for a while because I'm not giving up my iPhone. I hate the Google phone. But they're looking for their next product, and Microsoft could challenge them in the tablet thing. So who knows? But it's certainly not taking the shellacking, at least now that everything else was taking. But then again, it has a lot less to give away than the ones did.
Yeah, it's been kind of just taking a non-stop shellacking for the better part of this year, for the most part here. A few highlights notwithstanding around earnings back in April. They had a little bit of a brief shining period there, but that was really about it. The rest of the time has kind of just been languishing in this period here. So interesting to see kind of their size almost going against them at this point. They can't come out with another product that kind of just does okay because they need it to be such a home run to even move the needle. They're so big now and so large that anything that's not a grand slam doesn't really get the analysts or the public excited anymore. And so it's kind of a bit of a catch-22. They're so big that they need to have the next thing just be even bigger, and that's a difficult road to hoe if you have that kind of expectation heaped upon you. Speaking of great expectations, I'm going to toss it over now to the Viceroy to see what caught his eye and his interest today over there in the land known as OX.
The phones never stopped ringing today, and on the future side, it was crude and the metals. Gold down $94 today. So I expect in the next couple of days you will see margin increases in, I can almost say just about everything. But I think the spam margining programs are going to click at these levels. Gold, say, down 94. Silver down 2. A 10% move in silver. Gold is down 25% for the year. And another worthless but dorky statistic, which I'm known for, the GLD Trust, in addition to being down, has liquidated over 300 million ounces of gold. So the trust, for the first time in, I think, 5 years, has fallen below 1,000 metric tons. So it's kind of a double-edged sword. Not only is the price going down, but the trust is selling, which is driving the price down. So you have that, October 87 dynamic hedging. You have the perpetual motion machine going on in the metals. The 10-year, 240. The more we talked about this, we wanted a better rate on the 10-year, but we're getting, I think, more than we wanted. To Mike's point, it's not going to 5 overnight, I hope. But 240 is scaring a lot of people, and that's really what it's all about. And that was the trend worldwide today. The rate in the UK went up. Everything went up. The only thing that rallied today, other than the VIX, was the yen. And on the equity desk, it was Apple today. It was Apple puts. It's going to be a real interesting expiration tomorrow. I think today's the day, given that it's the day before conventional expiration, why market makers are not looking to stay in the market making business. When you move through 8 strikes on the S&P, and it was just a difficult day. I mean, it's one of those days. It's kind of like the last scene of Animal House, where you're saying remain calm, don't panic, everything will be okay, and then you get run over. Today was just a difficult day. Little bit of light. I was hoping I could tear my notes up again. The Dow rallied back to only being down 310, and then it just cratered from there.
Yep, no rewriting the script today, Mr. Viceroy. It was all red all the time today. Interesting point about the GLD trust, though. People tend to forget that. They think they're just trading these shares like any other stock. They forget that there is this repository of physical lurking somewhere, and just the sheer unwinding of that can have ramifications throughout the marketplace. People get so into these ETFs, they treat them just like stocks. They forget all of the underpinnings and logistical things that go into, holding a vast repository of that much of a commodity. It's kind of interesting stuff that we don't really hit on too often on this show, but worth mulling over every now and then.
Yeah, one other point. I think investors, our listeners, should be prepared to see margin level increases, because the kind of moves we're getting when, even in crude today, we had almost a 4% move. The margin metrics in the futures community and the margin metrics here in the securities community, I mean, we're on both sides of it. VIX moved 25% today. There are firms that margin VIX, the maintenance margin at 25%, right? Those firms could potentially have a problem today. And there have been problems with some of these products in the past, and firms have adjusted. And fortunately, the independent clearers today, I want to frame this correctly so it doesn't come out sounding bad, are better capitalized than the industry experienced a year ago, when you had one of the largest independent clearing firms borderline capital, having borderline capital problems, and in fact eventually going away and being acquired. But today was not an easy day. I mean, if you're on the right side of it, great. You're a genius today. We talked about this on Monday's show, and as somebody reminded me, I said, good news from Bernanke, 400 points. Bad news from Bernanke, 400 points. I underestimated it. So today was a tough day.
Yeah, and a good point as well about the margin. If you wake up tomorrow and you find a little bit more capital is tied up in your trades than the day before, don't be surprised. The Viceroy has warned you. And that is a good point, too, about just the industry in general. I think has clamped down on that quite a bit over the last year. We saw, of course, you're referring to the Penson debacle, and a lot of firms there really having very little collateral to go along with the massive number of customers and trades that they were actually clearing through that firm. I think the new owners seem to have tightened that up quite a bit and gotten a lot of heat for it in the process from those firms, but c'est la vie, they seem to have clamped down on that, and that should hopefully hold most of the customers in good stead on a day like today, where they're not blowing out left and right, and the firms as well, because they're the ones that really need to keep an eye on this stuff on a day like today when everything is bleeding red.
Yeah, one reminder, Mark, and I know I will get hate mail for this, but as a customer, don't think that margin is intended to protect you. Margin is intended to protect your firm from an unsecured debit. And if that's a little too brutally candid, then, they know where to send the email. But margin won't protect you. By the time you get the margin call from the firm, you got other stuff going on. I mean, imagine collateralizing things with stocks and bonds and trading something that got in the news today, your core SMA goes away because the stocks and bonds go down, and now you got a margin call because of the gold or the crude, and it's more than a double-edged. It's a real sharp double-edged. So be aware of what the issue is with margin, and don't be shocked when you get the email tomorrow. And I don't know this for a fact, but I think you're going to see the spam margining increases. You're going to see the firms that have VIX at allowable minimums. We're not one of those firms, and sometimes we get heat for it, but the thing moved 25% today. If you had it margined at 25%, you got a problem.
You can always count on Alex to throw a nice glass of cold water on the nonstop party that is the option block with your endlessly upbeat outlook, sir. But yeah, that is another good point. I'm just teasing you. That, of course, hopefully our listeners are savvy enough to realize that margin is not there for their defense. You have to be your own risk manager. It really is the firm playing defense for itself. And if it helps you in the process, that's good, but it's really not intended for that. It's intended to keep the firm solvent and live to fight another day. And speaking of fighting another day, it's time to roll on out of this segment and put on our fedoras because it's time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and welcome back to the old Odd Block. If you'd like to play along with the old home game, then surf on over to theoptionsinsider.com. You can find more detail on these and many other unusual activity alerts that we've highlighted from throughout the day. We're going to kick it off today because it is so timely with a big unwinding of a trade out there in VIX land. Of course, we touched on the VIX cash earlier today, closing up about nearly 4 handles, 3.85 handles to 20.49 on the day, breaking through the 20 handle for the first time in over 6 months. So a historic day from many different perspectives in the world of volatility. And as if you remember a week ago on our site, and I'm not sure if we hit on the show, but we definitely covered it on the site. We highlighted a looks like a pretty, in retrospect, very well timed bullish trade out here in VIX options. Someone came in and bought the 1620 call spread and financed it all with the July 17 puts. Well, guess what? That was a pretty big winner, given what we saw in the marketplace today. That one turned out pretty well, and that trader came back in today to unwind that trade 10,000 times, making about nearly a cool million in the process. So not bad for a few days worth of work. Mr. Andrew, why don't you walk us through exactly what this trader put on and when he put it on?
I was getting my vote for trade of the year in the Odd Block, I think, so far.
Trade of the year, wow. We had that one
so far.
We had that one last year. I went from like 20, or not earlier this year, from like 20 cents to about $9. That was a pretty good trade too. That was that
really?
GVZ. Is that the one?
Oh yeah, the GVZ vol and the gold. We had some.
No, that wasn't GVZ, but that's obviously the vol product. But it was something. I'll have to go back. Our listeners are screaming it to me now through their podcast player. It was X. Well, I'll go look back and see if I can find it before the show is up.
But I like this one though. This is the one I like. So this is the customer originally sold the trade was you're buying the 1620 call spread and financing it with the 15 puts. Now, the one thing about this trade, even though, and it was a good to the point earlier about margin is, well, this trade requires a lot of margin. You know, the risk for VIX going really far below the 15 handle was pretty slim. Going to this expiration, that was July expiration. So, while the guy had created pretty good upside, he didn't have, what I think reasonably is not very much downside risk. That was kind of the cool part of the trade. So I think he put the whole thing on for about 40-something cents, 49 cents, and he took it off for $1.33. So he sold out the call spread and bought back the put for $1.33. and he had that on 10,000 times. So darn near close to $1 million. Not too bad. Very, very, very nice trade, and pretty much I think a bet on that the market was going to take the next Fed minutes as we're getting out of the business. We're taking our foot off the accelerator type trade. So great trade.
Yeah, you're right. It was pretty well constructed. We like bullish risk reversals. We like bullish risk reversal / call verticals. A lot of good way to construct this and take some of the edge off of, because buying that call spread going into the Bernanke announcement would have been just atrociously expensive. So using a little bit of that 15 level as a bit of take some of the pain out of it was not a bad way to do it, and certainly paid off in spades today. All right, moving on here in the old odd block. Next up, Fleetcor Technologies, Inc., ticker symbol FLT. Like everything else today, this one bled red on the old street, down up nearly 5% to 83.94 on the day today. This is another odd block special that does about 500 contracts a day. Today, nearly 4 times that, doing nearly 2,000 contracts today, with the bulk of that volume really coming in these AUG 90 puts. Andrew, tell us what really caught your eye of these 1,500 nearly of these things going up, sir. Over 2/3 of the overall volume coming up in this one trade on this one strike.
The thing was, it was such a counter market sale. I mean, they whacked out the bid. Bid went away at the time, and last time I checked, the bid was still about 30 or 40 cents away from $7. There was no real open interest. So this is opening paper, like aggressive. Somebody's saying, I want to own this stock here. So maybe it's Tusaw. He likes Fleetcor Technologies, whatever the heck they do.
Got me.
But I felt it was a pretty aggressive type sale, looking for a spread against it. Nothing. It's an in-the-money put, so it's clearly somebody that wants to own the stock. So maybe they're going to be right.
Yeah, well, he's
already trading at the top of the range.
If that's what he wants, he's getting his wish, I think.
Exactly. Well, I was looking at the volume, and the volume was clearly whacking all the bids out. So I don't know how they can disguise that volume if they possibly bought those puts, because they were never offered anywhere close to $7. So really, again, I think it was it looked like an aggressive put sale to me, which is, I thought pretty gutsy today. Let's just put it that way.
Yeah, and if he was closing these out now, they'd be nearly $2 losers. They're offered at $8.90 right now. Granted, that's nearly a buck wide market, so you can get some wiggle room there. But still, this thing moved pretty aggressively in his face not too long after he sold these things. So
yeah, it looked okay, and then it didn't look okay.
That's one of those. I've had a few of those in my day.
Yeah, exactly. Woo,
it looks good. Looks good. Oh, what happened? I went to the bathroom. I pulled the Tusaw, and I come back, and now look what happened to me.
Exactly.
The Tusaw would take his smartphone with him to the bathroom.
Remind me never to touch any of your portable electronics, sir. All right, next up, we have aptly named Contango Oil and Gas. I think you put it in here just for that reason.
I did, actually. That one we just put in because the name was there.
The name is pretty good. This is ticker symbol MCF, because, of course, when you think Contango Oil and Gas, you think MCF. Why not? And the close today down about a buck exactly, actually, to 33.90. This is another one really lighting up the old options tape, doing about 200 contracts, did a whopping 438 today. So we'll kind of run through this one really quickly, but it seemed like the bulk of the action a little bit longer dated here in the old Jan 30s, which are actually in the money calls right now. So this guy, another one playing in the money realm.
To me, this was just a guy, because the stock is near the bottom of the 52-week range. And I just think he's closing. Like, he bought calls at some point in recent memory, and then he's going to close them out today. Check the open interest tomorrow on this one. But it kind of feels like I bought some calls, and now I have buyer's remorse, and I want out. Because the stock's already at pretty much the bottom of the range. So I don't see how they could have paid a whole lot of money for him, And as a sale, again, it's very much an open interest play. It's not much of a buy right. So that's how I see that one. It looks like somebody just trying to hit the road on more volume on a piece, just basically getting rid of a piece of the open interest.
All right, and that's going to do it for Ye Old Odd Block today. Like I said, if you'd like to read more about these or any other unusual activity alerts, surf on over to the mothership, the website. You can find all of this detail and much more over there on the site. But now we're going to keep on rolling right on into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, Mr. Alex, aside from watching Mr. Grigas' hair catch on fire today, what else really caught your eye over there in the ever-ringing land of phones known as OX?
The phones never stop ringing. I think we've said it all, but I'm going to preach a little bit. I'm going to do a little bit of a two-saw rant here and just reinforce that this is a market for options. And if you're trading Apple or you're trading energy or you want to play in Google or you even want to play in the 10-year or lower price stuff, you're looking at dividend stocks. I wouldn't own the underlying here. If I were going to add to positions, I would do it via the options market, and especially in products like energy and volatility. I'd look at trading the futures options here. Yes, I know volatility is up a little bit, and I get that options are more expensive now than they were a week ago, but there's a reason they're more expensive. Don't panic sell. Don't go rushing to dump stuff on the market. If you're really rushing to dump stuff, write some at or in the money calls to reduce exposure to the market. If you write in the monies, you're obviously going to reduce exposure a lot. But avoid panic selling and risk management. When I talked about margin changing before, don't wait for your broker to call you with a margin call. Don't hide from your broker. Be proactive. I heard a handful of calls today, fortunately not a ton, where the risk department had handed the customer over to the desk, and the desk was telling the customer to lighten up. We do a lot of calling on the Wednesday and Thursday before expiration, advising people of what's in the money and what's going to get exercised. And obviously today, a lot of stuff that was in went out, and a lot of stuff that was out went in. So be proactive. If you work during the day and you have a day job and you can't watch stuff, have a mobile device. I agree. I don't want to go after Tucson's mobile device without Purell and rubber gloves and maybe a hazmat suit. But make sure you can do something to look at your account. If you're at a firm and you're blocked from looking at your account, figure out what resource you need to get to, whether it's mobile or pad, but be proactive.
Wise advice, very timely advice for what's going on in the old markets today. And if you're bored, call up the Viceroy over there at OX and let him walk you through some stuff before he routes you over to the trade desk to finalize all your trading. Speaking of finalizing your trading, we're going to roll on out of the Express Block and keep on rolling right on into the Strategy Block.
The Strategy Block.
All right. And for you new listeners, this is the strategy block, of course, the portion of the show where Uncle Mike comes on down from the mountain with his stone tablets upon which he has inscribed some options, wit, and wisdom. Now, Uncle Mike, usually this is the point where I would turn to my birdies and they would whisper in my ear what's going on. But I was on vacation. Of course, I had the birdies go on vacation, too. They couldn't have been working the whole time I was gone. So they're still getting back in the swing of things as well. So all they keep whispering in my ear today is just twofer. They say we're going to get a twofer in the strategy block. 2 topics for the price of 1, but I keep telling them that cannot possibly be true. That is just too much value for 1 strategy block. Are they indeed right, sir? Is it a 2 for a day?
Not only is it a 2 for a day, but if the viewers don't like, or if the listeners don't like what they hear, I will give a double your money back guarantee on what they paid to download this show.
I like it. Strong endorsement, sir.
I even might make it triple your money back if it's really that upsetting to them. But nonetheless, let's go on. 2 things I want to talk about today. The first one is just kind of in addition to what we were talking about a little bit in the trading block, and that is risk versus margin. If you look at what the margin requirement is to trade the S&P E-mini futures, for example, it's something along the lines of between $5,000 and $6,000. I'd have to go and check to see what it actually is to tell you the truth, but your risk is not $5,000 to $6,000. It's much greater than that. It's $50 per point. So S&P 500 or S&P E-mini, I know it's not at 1,600. It's a little bit below that right now, but let's just say it's at 1,600. Multiply that by 50, that's $80,000 that you're actually trading when you only have approximately $6,000 of a margin requirement on there. So let's say that theoretically you're long the E-mini. Hopefully you weren't today, but let's just say in theory that you were, and you only have to have let's just say you even have $10,000 in your account to trade it. If the S&P goes to 0, then you're not out just $10,000, you are out $80,000. Now, obviously, hopefully the S&P does not go down that much, or we have a lot greater problems than your account, quite frankly. But my point is that you need to have an understanding of what the actual risk is as opposed to what the margin requirement is. If for some reason, let's say that you have $10,000 in your account and all of a sudden you lose $10,000, and let's say you're down $11,000, your broker's probably not going to say, oh, that's okay. Well, we should have had bigger margin requirements. Silly us. No, they're going to want that other $1,000 if it does go below that. So keep in mind that just because something's a margin requirement does not mean that that's what your maximum risk is on it. Now, obviously, if you have a put option in place or something along those lines, that's a whole other ball game because it's secured with an option. But if you're trading something that's levered, that has a greater margin requirement than the amount of cash that you have in your account, understand that there's a big difference between the actual risk and the margin requirement that exists. Now, the second thing that I want to go through today, about a month and a half ago, I think I had made the statement, there's never been a better time in the history of the entire stock market to sell than right now. And that was when we were at all-time highs. Now, with that, obviously, there became much better times to sell because the market created newer all-time highs. But at that time, what I was starting to do, and this was I was rolling up put options on various collars, as well as on a diagonal spread, which is a core holding for a lot of my clients. I was rolling up call options as a means of protection in case the market comes down. Now, once again, I've stated this on the show before, I'm a long-term bull. I believe that the market is going to go up throughout the next 5, 10, 20 years. I really have strong convictions on that. And by market, I'm referring to the stock market. But I think it's important that while being long-term bullish, I'm also short-term cautious. So today I did something in a strategy that I have not done since August of 2011. And this is back when this is back when the world was going to end due to the fact that we weren't going to extend the debt ceiling. The first time around, I believe it was, there was a big to-do in Congress and everything was happening and things were awful and the world was going to end at that point, I guess. Now, what I did today is similar to what I did at that time. Probably about 5-6 weeks ago, I had rolled up a 154 call. I believe that was the strike. I don't have it in front of me right now, but I rolled up a 154 call in SPY to a 166 call for the month of September as a way of protecting profits because of the fact that we had such a run up. And so I felt that volatility was at a low enough level to where it justified buying at the money premium. I became a premium buyer at the money. Holy cow, what a degenerate, sinful thing I did. But I did it because of the fact that I felt that volatility was at a low enough level to justify buying at the money premium. And I also did it because of the fact that it was, to me, it was an opportunity to protect profits in the market from the big run-up with which we had. So with that, I've been selling some premium against it, and I had originally bought the call for $5.20. I think it was $5.22, something along those lines. And so the premium with which I was able to sell against this 166 call over the last few weeks amounted to about $1.20. So around $4 was my basis for that call option. Now, with that, I'm not trying to talk about how I was trying to make this an ingenious premium selling strategy, because that was not the case at all. What I was trying to do with it is have some upside exposure in the marketplace because, after all, I am long-term bullish, short-term cautious, but not have a lot of money on the table. Now, what happened is the market obviously has come down since, I believe, May 22nd was the day we made our all-time highs. So because of that, obviously I've lost money on that September 166 call option. But here's what happened, folks, and this is why you need to have an understanding of volatility whenever you're trading. If you look at the VIX over the course of the last month, primarily today, we've had a big run-up in the VIX. So today I got out of that call for $2 and between $2.10 and $2.15. So what that did is that kept with our general rule of how we're trying to do this on things when the market's going up versus the market going down. We're trying to capture approximately 70% of the upside when the market goes up. That's our goal. And then when the market goes down, we only want to be on the hook for approximately 30% of the downside. So in this little run, it usually doesn't work out as well as this, but in this little instance, from 166 to 160, the market's down 6 points in SPY, and we're down just probably about 2 points. So with that, it's kind of working out pretty close to where we want to be on this. Now, next question becomes, well, Mike, why did you get out today? Why don't you want to get back in? How are we going to do this? At this point, folks, I am waiting until we get up. I want to see a little bit more of I want to see the S&P catch a little bit more of a bid. Who knows? It might happen tomorrow. I might be back in tomorrow. I don't think I will be, but I might be. But when I'm looking to get back in, I want to see us get a little bit closer to the 164, 165 level before I'll consider it. But likely, I'm not going to get back in until we touch 166 again. Here's why. Let's say that the market does go up again. I'm going to miss it. I totally understand that. I get it. I'm fine with that. But if the market does go up another 60 points, the S&P that is, or 6 points or $6.60 in SPY, if that's the case, a couple things are going to happen to that 166 call that I got out of. Number one, time decay. I'm going to have theta working in my favor because there's no ice melting because I'm not in anything. And number two, it's likely that if we do get that much of a movement back to the upside, in my opinion, volatility will come down. Now, if we go back to 166 right now, I will have lost. And even if we go back up to there over the course of the next few weeks, I will have lost, most likely when I get back into that, or I'll likely find another option to get back into. But let's just say in theory I want to use the same one for sake of simplicity. If that's the case, I'm going to lose. But here's the thing. I'm not going to lose as much as you would think because of the fact that options will likely be cheaper if we go up that much that quickly, and that's time decay with which I have avoided. This worked out for me when I've only done this once in the last 4 years, and this was when, like I said, in August of 2011, and what I was able to do, I could have gotten back into, the market did go back up to the original strike over the course of the next few weeks. I could have gotten back into the original strike at a lesser level than where I got out of it at when it was down, just because volatility went up so high. Now, I ended up getting into a different option, which I'll likely do this time if the market comes back. But long story short, which I guess I have made fairly long, so I appreciate everyone listening, that's how you can use options as a way to manage downside risk and still have some upside exposure at the same time.
Well, I guess my birdies certainly were not lying. That was quite the mighty twofer. Thank you for that, Uncle Mike. You may now return to the mountain from whence you came, and we shall continue on into our final segment, Around the Block.
Around the Block.
All right, and welcome to Around the Block. This is, of course, the portion of the show where we dive into what we're watching on our screens for the rest of this week into the old weekend. Perhaps we'll start with you, Mr. Rock Lobster. What is catching your eye? Are you perhaps waiting to see if we are poised on the precipice right now? And are you waiting to see, like the rest of us, if we continue to fall ever further into the abyss, or if we can finally, ever so effortlessly, perhaps, claw our way out of the abyss?
Yeah, kind of. I'm mostly some gamma, just unwinding a lot of that stuff. I'm unwound most of it today. I would like to, start looking to buy some stocks again. I'm looking actually now with the vol a little higher to write a bunch of calls against stocks. Overall, I kind of agree with Mike. I think we are still in a market going higher, and hedging is a great idea. It's certainly a tradable way to do things. What I'm interested in really to see if realized vol now has been blowing through implied volatility for probably 3 or 4 straight days, maybe 5 in the bigger indexes, at least in the SPY, SPX. And really I'm interested in if that trend continues to see if we can actually make some higher highs, because implied volatility, Mark and I have been beating this drum with our clients for, probably 2 weeks. We haven't been short any volatility. And just, you guys, sometimes, as Don would say, options are either meant to be sold or not. And this is, at least I think, one of the times to not sell them, at least not yet, until we see how the next couple of days starts to play out. But the Iron Condor trades like that, I think there are some trades that are going to start working better now that, a lot of these deep upside moves, are kind of out off the table. So a lot of trades that weren't working, and let's say the first quarter, I think have a much better shot of working out, like Iron Condors, those types of, short gamma trades that now you have some actual premium in there. The market going to all-time highs tomorrow, kind of tough. So, and, give yourself plenty of downside, below the 1500 handle or something like that. And all of a sudden you have, I think you have a shot at generating some premium, some theta against let's say a hedge portfolio. I think that would work out pretty well, actually. So I'm not convinced the sell-off is done. It went farther, like Alex said earlier, it went a little farther than I thought. But, I try not to think too much about positioning stuff like that. So I would be surprised if we sold off another 5%. Doesn't mean it can't happen. But I think that would take a lot of this, Bernanke premium for the year kind of right out of the market. So
yeah, that would pretty much squeeze it right back out.
And then it's gone, right? Then you go lower than that with economic growth. I don't think things look as awful as everybody thinks, and I don't think it's a problem of having cheap enough money. It's more of people kind of confidence and maybe some of the, let's just call it the non-monetary types of things that can make economies grow.
Must be exciting times for a diehard fundamentalist such as yourself, because now we have to sink or swim on our own profits and losses and don't have this endless flow of monkeys. Endless flow of monkeys. No, there's endless flow of money from Uncle Ben to keep everybody afloat.
I think so. And eventually I think we're going to kind of float, and just the market, it's better the market went through this now than a year from now. Like anything, it's sort of better that the economy took the hit on the fiscal policy, mostly because I think that was a confidence builder. It's the fact that the government can spend less money if they really decide they want to. Overall, I think if you're a business person, that makes you feel better. Like you don't live in a banana republic, because it's been a little confusing here for a couple of years with the runaway government spending. The Europeans, it takes them 3 years to make a decision. Congress, though, can make a decision relatively quickly when they want to. And then that is 3 months or 4 months. But Europe takes 3 years. We don't have that problem. So I think those kind of things were more, I think they had much more to do with the rally. And that talk has subsided, I think, which is not great for us either. The fact that, okay, we have all these big liabilities for Social Security and whatever. And those are the kind of things I think that could send the market higher when the government says, okay, we're really going to try to fix these problems. And then all of a sudden that chatter just went away, because all of a sudden the deficit basically dropped 50% from the year before. So, that's the kind of talk that gets people a little happier. Possibly too, don't discount the fact that there's this confusing healthcare thing going on that nobody knows what's going to cost a business. So, as a small business, we care about that tremendously. It's on the back of our mind. So, ultimately, is the realized volatility going to stay as high as it is, and will implied vol catch up? That's my number one indicator I follow. And as of right now, implied volatility is staying stubbornly below that level. It's a good trade, but we haven't gotten to that worry point yet about, are we going to fall off a cliff? Doesn't mean it can't happen, but from a market point of view, just there hasn't been that sort of, panic juice buying yet. It's just more like a smooth move up.
We would certainly need some continued aggressive moves in the old marketplace on the order of this 2+% a day to really justify these current levels in the VIX. So who knows? Perhaps we're in store for some aggressive days to come. But we'll have to wait and see. Days like today are always that argument for keeping some nice little rainy day puts in your back pocket for a day just like today. Quite a few fortunes on the old CBOE were built by, hey, I forgot I had these puts. So
because I already sold so much stock against these calls, exactly. I just can't remember the position anymore.
Exactly. All right. Speaking of nonstop selling of stock and options and whatnot, Uncle Mike, what are you watching for the rest of this week into the weekend?
Not much now. Just watching the tape to see if we can come back and see if I got to get back to work again. But if we continue to sell off, then we're going to be primarily in cash on the market-based side of it. Looking to do some rehedging and doing some stuff with silver and gold, but for right now, just holding off, and don't like to do stuff too quickly with things like that, and we'll see where it goes.
And in the meantime, if you are a client of Uncle Mike's and you're having a hard time reaching him, just try him on his personal devices in the old commode. That's where I usually can track him down. So keep an eye on that.
There we go.
You Uncle Mike clients. And last but certainly not least, Mr. Viceroy, what are you watching for the rest of this week into the old weekend?
Well, markets are thin. We've had 2 difficult days. It's clearly changed the tone. Earnings will begin next week. The home builders will come out next week. Walgreens comes out next week. Nike comes out next week. General Mills. Corporations are sitting on tons and tons of cash, which means if stocks get lower, you'll see corporate buybacks. It's, the British poster about remain calm. We've had a couple rotten days, but markets are thin. There isn't a day that goes by that there isn't another story about another market-making firm exiting the business. So I think moves are, going to be exacerbated. A 20 VIX means it is not uncommon for the market to move 190, 200 points a day. That's the expected one standard deviation range, and we're getting that. We talked about this on Monday. We had 10 days averaging 190 points. That's a 20 vol. To Andrew's point, today the realized was a lot bigger than the implied, and there's lots of people who spin that when you see realized bigger than implied, that bodes for in my experience, often a very good market following that. But it's certainly a market that's going to not trade in a narrow range. And next week, some good earnings, some good employment numbers. Bernanke does another news conference and is a little less hawkish. And all is forgiven, and we're up 500 points in a couple of days. So keeping a laser focus on the 10-year, worried that it'll get up over 250, 260, and then it gets problematic. So that's what we're looking at here.
I think all of us have really missed the key driver of the market sell-off yesterday and today, and that is, of course, the prompt firing of the founder of Men's Warehouse this morning because he can't connect with millennials. So if the man who says you're going to like the way you look, can't hold down a job in this economy, what hope is there for the rest of us? Hence the pronounced sell-off today and probably more to come. Because where Men's Warehouse goes, so goes the economy. And of course, on that ridiculous note, we're going to close out the old option block episode for today. And really quickly, before we go, let me just check in with each of my cohorts to see what they have cooking that may interest you, the listener. Starting off all the way in the land of Maine, Mr. Giovinazzi, what is cooking in the land of the pit?
Pit stuff. We have all kinds of stuff actually coming on our. Coming up, we have our gold boot camp, not to be confused with another boot camp on a very successful radio program. Next week, it's basically 1 hour a day where we hit a lot of the highlights of what we cover in our gold course. It's kind of like a truncated version of it, but it's certainly helpful. Of course, we go about trading options from a different point of view than probably most people. Also, Mark, so that's all week next week. We have, I think, one space or two spaces open. It's been pretty popular. Next week, Mark will be doing a webinar about picking stocks and using fundamentals with options to kind of to get that to sort of have your fundamental outlook match an option position, really similar to what Tusaw does. But he will be doing it with the very nice Miss Stephanie Link of The Street, and that will be next week. And then lastly, for all the people, all our pro gold and platinum, our pro and platinum clients, we have our Trader Summit, which of course will have almost nothing to do with trading, but everything to do with food, fun, and golf. There will be some trading actually as well. And that is at the end of July. So, a busy little summer for us in the old option pit.
I love how every time I toss it to you at the end of the show, you sound like it's the first time I've ever done this, and you're completely thrown off guard. What do you mean, stuff at the pit?
Mark's the one that handles all the scheduling for the events, and he's like, Andrew, you have to go do this event. I go, what day is it? And he's like, yeah. So, it's like ridiculous.
Pit stuff. I like that. All right. Let's moving on over to a man who's probably a little bit more prepared because he's got a webinar coming up. Uncle Mike, what is cooking in the land of RCM?
Oh, I didn't know it was my turn. Tonight, and actually it'll be last night, Jerry Woolert from the Rebound Rabbits is going to talk to us about his stock picking techniques, and we're excited about that. And so since it's the next day, you guys missed a great webinar. Feel free to send me an email. I'll be more than happy to send you a recording of it. And then in the coming weeks, we're going to have the webinar train running again. Next week, we may or may not have a special guest on Monday to have an interview for our upcoming Thursday night webinar. I'm going to keep everybody in the dark on that one, so tune in Monday to see if we're able to secure a spot for them in the Monday interview. And then in the coming weeks, I'm going to be donning my fedora, so to speak, and I'm going to be doing various strategy webinars myself, so stay tuned because TNT is going to be in full force in July. That is Thursday night trading.
Check out Uncle Mike in his fedora coming to a webinar room near you. And now last, but certainly not least, of course I'm saving the best for last, he is the Viceroy, and he's going to lay down some knowledge on what is coming up in the land of OX.
Well, there's a full webinar calendar here at OX, but I'll just showcase two events. Monday at 1 p.m., mini options. And again, we've talked about this a lot. They get a little better every day. And if you are a small investor, scratching your head listening to what we've been talking about and thinking, well, you know, I don't have enough critical mass in my portfolio for some of these strategies, come look at the minis. If you own mutual funds, you got $10,000 or $15,000 of mutual funds in an IRA. You can buy a SPY put or 2 SPY puts in the mini to give yourself some protection. Wednesday, Russell Rhodes from the Options Institute, my old shop, is coming over to do a VIX presentation at 1 p.m. But as always, there is, as we used to say in flight school, a full pattern of free webinars. All the events are free here at OX, so simply come to optionsexpress.com. You don't need a login. Click on the free education tab, and you can see everything going on.
All right. Thank you, Alex. And on behalf of course, Alex and Andrew and Uncle Mike and myself, I want to thank all of you out there for downloading and streaming and subscribing to this show and contributing to just the explosion of downloads and streams of our programs here on the Options Insider Radio Network. And we'll see you next week right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.